This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Ben Griffiths, thanks very much for coming on Talk Your Book. Really appreciate your time, especially considering the current market turmoil. I thought you could start by telling us a little about the Eli Griffiths Group and what you guys look to invest in.
Thanks, Chris. It's great to be here. Eli Griffiths Group, we're an emerging and small company portfolio manager. We've been around since 2003, so we've got some experience at this. We essentially target emerging and small companies, Australian listed, ASX listed, and NZX listed as well. And we have a propensity to invest in businesses that are well managed, with managers that are well aligned with shareholder outcomes. We like profitable businesses that are growing earnings over time. Ideally, over 3 years would be how our process would capture it. And we like to target growth industries. We traditionally invest in businesses that have exposures to macro themes that are developing, but comforted by the fact that we're investing in vehicles that are well managed, long-standing, strong reputations, and behave rationally.
And I know you've been looking at this company for a little while, but what company do you want to speak about today, and what opportunities has the market weakness potentially opened up?
Sure. Well, I guess that's the beauty of a soft market. You get to visit news stories, but I guess most significantly, you get to go back and dust the file on stories that you're familiar with and you're comfortable with, and the price is reset. And I think Auckland International Airport's probably fits the bill there. And that's a stock that we've owned off and on for a long period of time. For those of your viewers not familiar with it, obviously it's Auckland's major airport. In fact, it's New Zealand's major airport. It's a monopoly operator. Essentially, the only way in and out of New Zealand en masse is really through Auckland. They've got 205 hectares. They don't have a curfew. Planes can come and go. It's a passenger and freight hub, and it's been growing like topsy. About 20 million people a year find their way through Auckland International Airport. Now, the company, by their own projections, say that number will swell to 40 million people by around 2044. So it's a strategic asset. It's pivotal to the makings and the operating of New Zealand, and it's trading down in the market. And the market's tossing it out. I think what we're getting excited about it is you're getting a long-term business, an extraordinary long-term franchise, being valued on the next 12 months' earnings, which for us is ridiculous.
And so airports by their nature have different revenue streams. There's retail revenue, there's the renters they get from a property developer, and there's the fees they get from passengers. Which of those revenues do you think are at risk of taking a hit in that next 12 months, and which are a much more reliable stream of revenue that you can forecast for the next 5, 10, 15, 20 years?
Sure, no, that's a fair question. You're right. Auckland enjoys a blend of revenues from aeronautical charges, landing rights and landing fees, retail, as you mentioned, car parking, and of course, property development. So each of those play a crucial role to varying extents. I think retail's been the big one, and aeronautical charges. Look, they are all to some extent subject to the vagaries of passenger movements. Fewer planes means, I guess, fewer landing fees. Retail clearly will rise and fall on the whims of consumers, whims of travellers that are making their way through to the airport, and retailers that, of course, frequenting some of the assets that live outside the airport footprint, but within the acreage. The property development side has been a thriving earnings generator for this business. I think I read somewhere that Auckland International Airport is perhaps New Zealand's largest property developer. So they have a substantial, I think I mentioned, 205 hectares, give or take, of developable land and expandable land. And essentially that really will underwrite a very steady and disciplined rollout of what sort of infill they should be doing on the property side. So they have some diversification within that mix. They're not only exposed, of course, to aircraft movements and lower passenger movements, as the case may be. They have other exposures.
And they've got higher EBITDA margins than other airports globally. Some people say that's due to a reasonably positive regulatory framework in New Zealand when compared to other countries and how they interact with their airports. What effect could something like coronavirus have on the regulatory environment for airports that may be a benefit or a hindrance to those margins going forward?
Now, look, that's a great point. Coronavirus will have a number of impacts on the business, and immediately it is certainly on passenger movement. On the regulatory side of things, I guess the way in which they rely on a price set event where the Commerce Commission will decide upon a rate of return they should enjoy for a set period, a 5-year window. They have satisfactorily moved through one of those price setting windows. They're about to move into price setting window 4, where they'll have to negotiate an outcome. I think, and this is perhaps not being appreciated by the market, but I think that during those negotiations with the regulator will learn that owning and operating and managing an airport is not like running a utility or a freeway. You do have volatility in your throughputs. You do get lower passenger movements and therefore lower plane movements. And so all of a sudden your utility type behaviour is a little different. There's a bit more riskiness to it. And I have a sneaking suspicion that that's a card that perhaps Auckland International Airport will play when they sit down with the regulator to say, look, we've enjoyed a 6.4% return in the previous price setting negotiation. Looking forward, that might not be enough. We might need a little bit more of a risk premium in that for us to manage what is, clearly there's some risky outcomes with passenger movements. And it's not just Auckland, of course, it's every major international airport, every major airline are having to cut their cloth to suit the changed environment. And looks like that's not going to cure itself quickly. The other thing I think where coronavirus and its ultimate treatment will work nicely to Auckland's is the fact that the travelling public, wherever they may be, whether in China, India, the United States, I think by the time we've finished with this horrible episode, travellers are going to be seeking out clean, green, safe destinations where they can holiday without great fear of not coming back. And I think Auckland, and in fact, Sydney, Melbourne, Australia fits the bill as well. We are clean, green destinations, and I think that's another element to the story that I think is perhaps in the haze and the fog of coronavirus is being missed.
And you mentioned the property side of the business. They've got 200 hectares of land that's been undeveloped. What do you see them using that for in particular?
Well, they've got what they call 8 anchor projects basically scheduled. 4 are underway and 4 are awaiting approval. The first bunch of projects, which will tally to about $1.5 billion worth of spend, involve essentially modernising and expanding the airport footprint. They're going to spend about $1 billion in round numbers on the domestic jet hub, and they'll spend $350 to $500 million on the international arrivals hall. And they'll spend those monies, they'll develop those assets. We think that they'll be up and running by 2023. And that is significant, Chris, in that it's the first quantum step, a substantial step in an expansion to that airport. Previously, there have been incremental changes along the way which haven't had a major impact on things. This is a quantum step up. So that's sort of phase 1, $1.5 billion round numbers of spend, which goes into that regulated asset base where they earn their required return on. The second thing, which is, again, gone seemingly, please excuse the pun, gone under radar, is the fact that they've had their second airport, their second runway approved. So the New Zealand government have approved the development of the second runway. Now that could easily have been fairly controversial. It could have provoked activism and a community response. They've been able to very discreetly and skillfully achieve an approval status from the government. Now that's enormously beneficial. That keeps them on the timeline for a 2031 opening. And so they've been able to do that. And the board will give go-ahead, yes or no, and a final investment decision somewhere around the middle of 2020. And that's probably a $3 billion spend. It's an enormous spend. So you're going to see the regulated asset base of this business double in the next couple of years and triple in the next 10 years. And again, that is where they strike their regulated return on. So that's an enormous fillip for the business. Yes, it involves levering the business up, and they'll raise money perhaps by equity, and they'll certainly go to banks to require funding as well. But that is, as I said before, essentially a quantum step up in a business which is already forecast to double its passenger throughput. It's an extraordinary step that the company's making, and we're excited about it.
And what does their debt position look like on their balance sheet?
Debt position, well, like all utilities, they will have a reasonably fulsome debt exposure, and there's no getting away from that. But that's how utilities work. That's how utilities can work. They have reasonably well-defined throughput numbers. We know what they can charge. And so that sort of business should have an efficient balance sheet, and that involves extending the level of debt, which they'll do. But knowing management as well as we do, debt will be managed within covenants and debt will be managed carefully. This is a very conservative management team that aren't given to capricious movements on debt raisings or expenditure. There's a well-considered model. So whatever they targeted or the final debt number they land on or the amount of leverage in the business, I'd be satisfied as a shareholder that they'll be acting in all parties' best interest.
And debt is at all-time lows. Interest rates, do you forecast that going on for an extended period of time, potentially being a tailwind for this sort of an asset?
Absolutely. No, absolutely it is. When we look at valuation, there's a number of ways to skin a cat with this particular company. We at Ely Griffiths Group look at it in terms of its quantitative aspects and its qualitative features. And on the qualitative side, I've sung the praises of management, who I have a great regard for. I've also sung the praises of the industry structure. They are a monopoly provider in what I would describe as a reasonably high growth, moderate to high growth environment. So your qualitative scoring is high, and as far as our process goes, that reflects prominently. On the valuation side, it's a bit hard to use standard PEs on a business like this with such long duration earnings. PEs kind of don't work. You just don't get a good outcome. So we tend to have a look at other measures, and you can look at a targeted yield where you impute a level of long bond and add a risk premium to it. You can use an EBITDA multiple, what you consider as a satisfactory or an EBITDA multiple in step with similar assets anywhere else in the world. And you can do the old vanilla DCF, adjust for debt, adjust for investments. No matter which combination you run with, just on the base valuation, you can land at a number between about $7.70 a share through to about $8.60 a share on any of those measures. The last trade's about $7.20. And those valuations don't give much regard for the ultimate expansion benefits that we're going to see. I mean, I've touched on the passenger numbers and how big the footprint's going to be, but I think that the spin-off benefits of what they're doing and the scaling and the operational efficiencies that they'll get, I think that sort of valuation range for us seems conservative. We've been using the softer market. You opened a discussion talking about a market that's going to provide opportunities and been under pressure. We've certainly been doing that. So that is a stock. To repeat my opening headline, it's a stock with a long-term franchise, right? A long duration earnings base and being priced on the next 12 months' earnings. I mean, that's when logic sort of gets cast aside and panic takes over, and that's kind of what we're seeing in markets at the moment, and that's where opportunities come from. So we've been buying Auckland's.
Is the stake in Queenstown Airport material for them?
Look, it's immaterial.
Yeah.
It's immaterial. They had some Australian assets which also were immaterial, and they divested those. Look, Queenstown, they keep it there for perhaps strategic reasons. Perhaps they don't want another operator in the market. But there are other owners, of course, of Wellington's airport and, of course, Christchurch's. But look, the asset down in Queenstown is neat. I think it performs strongly. I mean, everybody seems to go to Queenstown from Sydney and Melbourne, winter or summer. So I think it's a nice little earner. I think
you don't think they'll divest that?
Well, I'm not budgeting or planning on them divesting it. I think for strategic reasons, they're just sensible to have their foot on it, to keep another operator out would be my suggestion. Look, I don't think it brings a lot to the story. At the same time, I don't think it takes too much away from it.
Great. Well, sounds like a really interesting story, particularly in these times. Thanks so much for coming on Talkie Book, Ben.
Cheers, Chris. Good on you, mate. Thank you.
Shaking hands like a couple of psychopaths still. This episode of Talkie Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients.
If you're enjoying Talkie Book, make sure you subscribe to Chris Judd Invest.